Here's the same company where the GP gets a 2x return on a $44 million investment. And we propose that the EBITDA increase from 20 to 30 comes from growing revenue from 80 to 100 million while it expands its EBITDA margin from 25% to 30%. The first thing to do is to calculate all the deltas, averages, and multipliers as follows. And the math in VC 110 tells us the $20 million revenue increase gives us fund level equity value creation of $14.14 million. Now, let's assume that over the whole, the addressable market increases by 10%. This means we have a beta of 10% and an equity return multiplier of 1.10x. We can now calculate addressable market growth, take the R1, R2, and beta from the table, and plug them into the formula to provide addressable market growth of 6.04 million. Next, we calculate alpha. The highlighted numbers give us everything we need. We get an alpha of 13.4% and an equity return multiplier of 1.134x. Here we see that our alpha is bigger than our beta, so we should expect more market share growth than addressable market growth, and that's what happens. When we plug R1, R2, and alpha into the formula, we get addressable market growth of 8.10 million, and as expected, the 8.10 and the 6.04 add up to revenue growth of 14.14 million.